Hello, my name is Jim Lindsay. I am the director of the Robert S. Strauss Center for International Security and Law, and I want to welcome you to our conference, Bridging the Gap, Universities Meeting Global Challenges. The Strauss Center was created in recognition of the fact that globalization is fundamentally remaking the world as we know it. It is creating new challenges and opportunities. It is producing new actors and entities, and it is posing difficult dilemmas for policymakers and the public alike as they strive to deal with our increasingly interconnected world. One thing that is clear and obvious about our globalized age is that the challenges we face are both complex and multidimensional. Think of climate change, which involves issues ranging from science and technology to fuel consumption to consumer habits to political cooperation to how our economies produce and use energy, or the war on terror, which is not simply a national security issue, but involves things ranging from cultural differences to religion to technological issues of how to protect the homeland. Or think of the international financial crisis, which in many ways began with a few people in Modesto, California, and southern Florida defaulting on their mortgages and reaching the point where it has created not just local or national ripple effects, but global ones as well. Now, finding solutions to these complex, multidimensional problems will require the cooperation not just of governments, whether at the state, federal, local, or international level, but also among business, government, and non-governmental organizations. Universities can and should play a role in helping the public and policymakers deal with global challenges. The role of the public or of universities should not just be in generating ideas, but in trying to bring a wide variety of stakeholders into discussion. Universities not only have much to offer to the world beyond the campus, but also a lot to learn. The Strauss Center is very fortunate that the Ford Foundation in New York has generously funded a project to bridge the gap, to bring the University of Texas and private sector and non-governmental organizations in closer collaboration to discuss pressing global challenges. Over the next 2 days of this conference, we will be attempting to make sense of the complexities of globalization by examining key trends in world affairs. We will be traveling the waterfront from financial regulation and accounting issues to energy issues to security issues to the status of the world's international financial architecture. Our goal in this conference is not just to identify problems and trends, that is an important part, but also to generate an agenda of things that not just the University of Texas, but other universities should be doing in a way that we can better, as universities, mobilize our talent on our campuses, provide solutions to pressing programs. I'd like to stop here for just a moment to take care of two housekeeping matters. One, I would ask if you have a BlackBerry or any other device that is likely to go off and start playing Tchaikovsky or Eminem, that you either mute it or turn it off. And second thing is that if you have parked down below, please see Laura Jones of the Strauss Center, and she will give you a parking tag that will allow you to exit the garage without contributing to A&T's Center's coffers. Having said that, I'd like to introduce Professor William Kinney, who is the Charles and Elizabeth Prothero Regents Chair in Business, who will moderate our panel on financial reporting accountability in the global economy. Bill?
Thank you. It's a pleasure to be here this afternoon. I am an accountant, and we often think of accounting as a boring subject that has little public interest. But today, I think it's fair to say that if truth were known, that accounting is central to solutions to many of the problems that we face in the world right now. And we have a panel that will help explore some of the edges of that claim and see what you think by the end. This morning we have, I'm Bill Kinney on the accounting faculty here at University of Texas. I teach auditing, which is part of accounting, but it's the verification that the accounting rules have been followed properly by global corporations. And not directly concerned with international accounting, but we do have those who are so concerned. Ross Jennings is a professor in the Macomb School as well, who teaches financial accounting and has also been our chairman. We have Christopher Hosfeld, Visiting us this year from Paris, who has international experience with international accounting standards, and Philip Denning, who is an accounting policy advisor at Royal Dutch Shell. And they will allow us to explore different aspects of financial reporting. I'd like to begin by asking you a question in the audience, and just to see if we're on the same page here. And the question is, from your perspective, and I don't know what your perspective is, do you think it would be a good idea if all corporations in the world that had global exposure, if they kept their books or reported their activities on about the same basis, used the same methods approximately so that one could compare reports of performance, could report and assets on a comparable basis? How many think that would be a good idea as opposed to a bad idea? You hold your hands. And I would say this is near 100%, and that's common. The usual case is when you ask people, should the accounting be the same, people almost always say yes. Sounds like a good idea. We're going to see today if that is the case, to explore those. Today we have in the world many jurisdictions, many governmental jurisdictions, but one worldwide market, essentially, for investments and for managerial talent. Management talent, investments worldwide, governments local. United States government is big, but it's not worldwide. Financial reporting, then, is essential to keeping track of things and to have accountability. The lack of accountability is, in large measure, responsible for some of the problems that we face today. And an accounting reporting system, a financial reporting system, has three essential elements. Accounting methods, the way the books are kept, many ways to measure things, and accounting methods give a prescription as to how one ought to keep the books. But sometimes mistakes are made or biases introduced, so you need to have auditing of the application of methods to make sure that these methods have been followed, at least close enough for practical decision-making purposes. And third, the third leg of the stool, if you will, is enforcement of these laws and regulations and to prevent lying about what you've done. Now, historically, these three have been combined. The accounting method prescriptions, the auditing rules on auditing to see if you got close enough to the correct application, and enforcement, typically done within a country, all three under the same mechanism. For example, in the United States, the Securities and Exchange Commission is responsible for all three of these. But yet, information technology and other changes in the world in the last 20 years has led to worldwide markets and to global corporations. Corporations bigger than any one country. Royal Dutch Shell is a European company but has influence around the world, and there are numerous companies such as Royal Dutch Shell that are global in scope but no single worldwide government. So the question is, how can we have control? Credible financial reporting is central, and in fact is the only way, which I'm aware, that we can get comparable information across jurisdictional borders. But what should be the methods of accounting? Who should decide those methods of accounting? And how will investors be able to believe these numbers as being reliable? And then how can we discipline global corporations? Is corporate reputation enough? For some companies, yes. For others, not. Is reputation of global network auditing firms enough? They're pretty good. They're global in scope. But is that enough? What enforcement should we have? We have local enforcement, but we think, anyway, a need for global accounting standards and global auditing standards. Today, we're fortunate to have three experts in international financial reporting standards. We're going to use many abbreviations today. IFRS is one of them. That means International Financial Reporting Standards. But our experts today can comment on the accounting and some of the promise, the problems of international financial accounting standards. And also, I'll be able to comment, if we get enough time for this, to some degree on global auditing and global enforcement. But first, I'd like to start with Ross Jennings, who is an American and has American experience in both American accounting and IFRS. And I'd like to ask Ross to begin. What has been the American experience to date with respect to accounting methods? How are they determined? How are they regulated? And what changes are on the just over the horizon? Ross, you can start. I'm sure we can go further when we
Thanks, Bill. Thanks for that lead-in, and I'm pleased to be here as well. So I want to give a little bit of background, as Bill said, about how accounting methods have been developed in the United States. And the current standard setting process goes back to 1973 when the Financial Accounting Standards Board, the FASB, was created as the private standard setting body in the United States. So as Bill said, the SEC, the Securities Exchange Commission, has responsibility for setting accounting standards in the United States, but they've always delegated that to private bodies. The Financial Accounting Standards Board is a private body that sets the accounting standards. It currently has 5 members. It's headquartered in Norwalk, Connecticut, and they're responsible for setting accounting rules in the United States. Throughout its 35 years of history, it's been a pretty stable body. Not a lot of changes have gone on. At the same time, coincidentally, in 1973, another body was created in London, England, the International Accounting Standards Committee. And they were not designated by any country. They just sort of arose to try to take on the challenge of creating international accounting standards, sort of the Esperanza of accounting. That organization has gone through many shapes and forms over the years as it has first went through what I call its big tent phase when it ratified standards that just included all practiced in the world. And then they went through their comparability project stage where they tried to narrow those standards down to a smaller set of higher quality practices. Then they reached an agreement with an international securities regulating organization on further refining the standards and raising their quality and getting the agreement of that organization to endorse those standards for international listing of securities. And then most recently, they even changed their name to the International Accounting Standards Board and changed certain elements of their practices so that they would have more international legitimacy in their standard setting practices. So they've gone through a tremendous evolution. Now, meanwhile, over the last 3 decades, there's been a lot of pressure for an international set of accounting standards. So this group stepped into sort of to fill a vacuum at a time when there was a lot of pressure to fill that vacuum. And in the United States, well, what have we been doing? Well, back as far as 1996, the SEC started thinking about, well, what would the United States do if there were a set of high-quality international accounting standards? Would we adopt them? And so in 1996, what they said is, well, those standards would have to have the following 3 characteristics. They'd have to be comprehensive and generally accepted basis of accounting. They would have to have high quality, and they would have to be rigorously interpreted and applied, which gets to the auditing and regulation aspects that Bill was talking about. Meanwhile, the FASB, that sets accounting standards in the United States, and the IASB, that sets international accounting standards, began to work together very closely starting in 2002. 2002, they reached an agreement to set their agendas jointly and work toward narrowing the differences between U.S. accounting standards and international standards. They further reached a memorandum of agreement in 2006, and then last fall they updated that memorandum of understanding. As a side note, for the last 5 or 6 years, I've been attending a conference between the FASB and accounting academics in the United States. And I can say that the presence of international standard setters has only grown over time, over the 5 or 6 years I've been attending that conference, as the topics at the conference inevitably are agenda items on the agendas of both boards. So they're working very, very closely together. On the SEC side, the SEC issued a concept release, or excuse me, a proposed rule in 2007 that would, for foreign companies whose shares trade in the United States, would drop the requirement for those firms to reconcile their international accounting standards financial statements with U.S. rules. So this was a big deal at that time.
The reconciliation, so they keep their books on international rules, and then when they file in America for our exchanges, they have to explain how they differ and
Correct.
line by line?
They would file their financial statements under international rules, and in the footnotes would reconcile those financial statements to U.S. rules. That footnote reconciliation was dropped in 2007.
So before, you could work from one to the other, just like in reconciling a bank account.
Correct.
And now they don't have to do that.
That's correct.
Okay.
That's correct. And this only applies to foreign companies whose shares trade in the United States who prepare financial statements under international accounting standards. They're prepared under Mexican accounting standards. The reconciliation requirement is still there. At about the same time they issued that proposal, the SEC issued a concept release to try to explore the idea of how would we move forward in requiring U.S. companies or permitting U.S. companies to file financial statements in the United States under international accepted accounting principles, not under U.S. accounting principles. They got a lot of feedback and comments from the public on those, on that concept release. And I would say the three main comments from the majority of respondents were, one, support for requiring international accounting standards in the United States. So it appeared that the respondents, many of them large corporations and auditors, were prepared to make this step. Second, they left open the possibility, the respondents, they left open the possibility of a transition period in which companies would have a choice between U.S. GAAP, U.S. generally accepted accounting principles, and international accounting standards. But, and importantly, the majority supported a date certain by which all U.S. companies would be required to adopt international accounting standards and not leave that choice between U.S. standards and international standards open-ended. Okay, that was a concept release, not really a rule proposal. They came out with a more serious proposal in November of last year, in November of 2008, often referred to as the roadmap proposal. And in there, they basically proposed that in 2009, U.S. firms, a limited number, a narrowly defined group of U.S. firms, be allowed to voluntarily choose international standards. That in 2011, the SEC would revisit the issue and vote go or no go on requiring U.S. firms to adopt international standards. And if it was a go, the requirement would begin to take place in 2014 for the largest firms, and the requirement would be complete by 2016 for all public registrants with the SEC. So that was put out for comment period, and the comment period was supposed to end actually today. And, but it was recently extended by the SEC to April 20th because many firms said they were just too busy with year-end closing right now to respond, but wanted the opportunity to respond. Okay, so looking ahead, there are a number of large economies that are set to adopt international accounting standards in the next couple of years. Brazil, Canada, India, Japan, and South Korea have all already committed, in addition to countries already on international standards, such as the European Community we'll hear about in a moment, Australia, New Zealand, and others.
So is it fair to say that these governments are adopting privately set standards by a worldwide or a broadly constituted group called the International Accounting Standards Board? This is a private group, and they're setting standards, and governments are now individually adopting these as the rules to be used in their country.
Well, that's correct, and that's a big issue. It's certainly a large issue in the United States, and I'll say a little bit more about that in a second. But it's a large issue in every country to basically cede their sovereignty over accounting rules to this more or less remote, private body that's accountable in some sense to no government.
But yet it allows a worldwide capital market to exist,
Correct.
And also monitoring of these corporate executives in this common basis of accounting
Right.
around the world.
So the U.S. and other countries are valuing that balance. Ceding sovereignty is what we get in return, worth giving up our control over the process.
I see.
So the most recent developments in this, and then I'll stop there, came out of the Senate confirmation hearings for Mary Shapiro, Mary Shapiro was appointed by President Obama to be the new chairman of the Securities Exchange Commission. And in her questioning by the senators, this issue of the roadmap proposal for the U.S. adoption of international accounting standards arose. And she made several points, all expressing concerns about moving forward too quickly on this issue. One point was the cost to corporations of going through this transition from U.S. accounting standards to international standards, especially during the current economic downturn. The second was whether the International Accounting Standards Board and its parent body, the International Accounting Standards Committee Foundation, whether they have enough independence and financial stability to be an entity that we are comfortable ceding our accounting national sovereignty to. So that's another issue. Another issue is whether the standards that are currently in place by the International Accounting Standards Body are sufficiently strong. And some people view it that we should let the two boards, the Financial Accounting Standards Board in the United States and the International Board, continue to work together for a few more years and continue to narrow the differences between U.S. standards and international standards. And then the final point she made was the potential for variation in the implementation and enforcement. This gets back to the auditing and regulation that Bill brought up earlier. And that's, the rules are only a part of the puzzle. The auditing and regulation are incredibly important and become much more difficult in an international setting than they are in a national setting. So I would say there was tremendous momentum a year ago toward moving toward international accounting standards in the United States. That momentum, partly because of the economic downturn, and perhaps partly because of the change in administration, is slowing down somewhat, so it's difficult to predict exactly what the next step will be.
Thank you. This sounds like there are some problems in America, but also a lot of potential here to improve things, and we're moving forward, but perhaps not as quickly as we thought a year ago. You mentioned the American situation with IFRS, and we've not yet adopted IFRS in America, but in Europe they have, and we're very fortunate to have Christopher Hosfeld here today, who has had experience with application in the European Union and also in the various nations, 26 or so?
27.
27, okay, it's hard to keep up.
Yep.
And in that community, and I think it would be useful, Christopher, if you could tell us what commonalities, or what is the state of application within the European Union, and what commonalities exist across borders, and to what extent is there still some nationalism or nationalistic behavior regarding this, and just in general, how has this worked out in the European Union so far?
Okay, well, first of all, I would like to thank you for inviting me to this panel. I'm very happy to give my opinion on the issue and to see what and how accounting harmonization worked in the EU. We have to go a little bit back in history. The European Economic Community was founded in 1959, and very early the basic idea was to create an internal market by the EU member countries, which meant basically that you could buy and sell products in any other country without even noticing that you were selling to another nation. In fact, that was the idea of the internal market. And the cornerstone of this internal market for companies to be able to do those decisions to buy and sell their products on a European-wide basis, accounting harmonization was a very important point. Because since companies have to be on a level playing field, you need to have probably identical or comparable accounting rules within the different countries. And therefore, in the early 60s, the EU started to harmonize accounting by by setting up working groups, and later on by issuing so-called accounting directives. Those directives, in order to be applicable in national countries, they have to be transposed in national laws. They're not applicable automatically. And in those directives, there were many options because, countries could not always agree on what the right accounting treatment should be. And the procedure where every country had a veto right made it basically impossible to get to a common text if you do not include options that please more or less every country. So now when those EU directives were implemented in the different member states, of course, every member state picked the options that it liked the most. And of course, those options were the ones that did not change too much compared to what this country was used to do in the national GAP before the directive was applicable. A second objective of the accounting harmonization within the European Union was to obtain mutual recognition by non-EU countries, which means that, well, the EU was hoping that once we have a EU accounting standards, they could go to other countries, and in specific, of course, to the US and the SEC, and to get those accounting rules recognized as European rules, and eventually allow European companies to get listed on the New York Stock Exchange, for example, without presenting a reconciliation, as was mentioned. Now, in the early 90s, the European Commission and the head of governments and also the companies, they recognized that the European accounting harmonization had failed. Because first of all, there was no European accounting gap, because every country continued to work with its national specificities. So the harmonization in terms of comparability was not achieved. And secondly, there was no mutual recognition, because the SEC and other regulators around the world, of course, recognized that there is no unique EU accounting, and for other reasons as well, they did not recognize this as somehow comparable to US GAAP, for example. And therefore, European companies were still had still to present a reconciliation from their national GAAP to the US GAAP, for example, or Japanese GAAP if you are listed in Tokyo. Now, the European Commission had now different solutions how to solve this harmonization problem. The first solution was, well, the old directives did not work, so let's make some new ones. But this was not really an option, because when the first accounting directives were issued, there were only 6 and later on 9 member states. At the beginning of the 90s, we were already 12 member states, and of course every time the negotiation gets more complicated as you got more countries in, and sometimes with different accounting cultures. And even the very first accounting directive, it took it 13 years to get it out with 6 countries. Now you can multiply this, if you have 12 countries, how much time this would have taken to get a new directive, which again has to be implemented into national law, which takes another 5 years or 10 years. If you are in Italy, and I don't want to hurt any Italians, but it may take 10 years before it gets implemented in Italy, which means you get the directive out today and it's applicable 25 years later. So this way you cannot catch up with your accounting rules and get something that is applied on a worldwide basis.
Isn't there a European Union SEC that can do this, or can't the individual nations' SECs solve this problem just by getting together?
Well, there is no European SEC, and well, that's the charm of having diversity.
But each country has an SEC.
Well, also that depends. I will come to this point a little bit later.
Sorry, I'm getting so excited. I'm getting ahead of myself.
Well, that's great. About this. And all directives have to be implemented by national governments. And even if you had an SEC, of course, the government is always above the SEC. So if the government wants to hurry up things, they can. And if they don't, then they don't. And again, in Italy, it took them more than 10 years to implement it. And it was long overdue, because for all directives, of course, there's an official implementation date. But here again, if nobody is checking if you respect the date, then you do whatever you want to do, even if it takes 10 years. So the first solution to set up a new directive was not really an option. The second solution would be set up something like the European Accounting Standards Board. But again, since there were no European rules, this Accounting Standards Board would have to start from scratch, like defining what is an asset, what is a balance sheet, and so on. And again, with 12 or more countries, this would probably take even longer than redo the directives. So the third option, and the only viable one, was, well, adopt within the European Union accounting standards that are already there, that exist, and that are well recognized by international regulators, by financial markets. And there basically you had two choices. Either you take US GAAP or you take IFRS. Of course, US GAAP was not possible for political reasons, because you cannot prescribe to European companies to use accounting standards that were made by Americans for Americans in an American environment. So that poses some problems. And while some member countries were not very eager to simply adopt American standards for other historical reasons. So the better and politically acceptable option was to use IFRS, because it's not linked to a particular country. And therefore, well, it's politically more acceptable. And therefore, in the beginning of the 90s, the EU Commission took the strategy that on the medium term, IFRS should be used within the European Union. They started working together with the IASB, the standard setter, in order to see how this could work out. What do we have to change on European level? What are we asking the IASB to change that it's easier for us? And this process ended in 2002, when the EU Commission issued EU regulation, which a regulation is directly applicable in all member states. And this regulation made it mandatory to use IFRS for group financial statements in the European Union for listed companies only, starting in 2005. But besides those listed company group financial statements, of course, and in the European Union, in fact, there are only 9,000 or so listed companies, so it's not at all the same proportion and importance as in the US. You have millions other companies that still have to prepare separate and individual financial statements. And to those separate financial statements, IFRSs are not necessarily applicable. Here again, that depends on every member country. I can say that for France and for Germany, for example, IFRSs are prohibited to be used in individual financial statements. In Eastern European countries, they usually apply IFRS on all financial statements because they don't have a long accounting history in terms of accounting standards. Because they were communists before, communism accounting works differently, if it works at all, I don't know. But they had to change completely their rules. They didn't have an accounting history, so they said, okay, we take IFRS for everything. But in the more, well, let's say Western European countries, since there is a long accounting tradition, IFRSs are only for group statements, and national GAAP, French GAAP, German GAAP, and so on still exists, and there still are major differences, depending on the countries, between national GAAP and IFRS. And national GAAP, compared to the US, is very important. Why? Well, because individual financial statements that are linked to a legal entity, every corporation has to present and to disclose its financial statements, are much more important in Europe than in the US because of the tax link. There's a link between what you show in your financial statements and the corporate income taxes you have to pay, which is not so much the case in the US. And also there are legal links. That means that in company laws, there are many sections that relate to your financial statements. So what you do in your financial statement, it's not only for shareholders on the stock market, it may have legal implications on declaration of bankruptcy, but also, for example, on what dividend payments you can make. And for those tax and generally legal reasons, it is still important and mandatory to present individual financial statements, and they are still made in national GAAP. And as I mentioned before, those national GAAP statements are not comparable within the European Union because you still have German GAAP and French GAAP and Italian GAAP with all those differences.
So many companies keep their books two different ways.
You have to.
You have to. Okay, it's not just they do. So you've got to keep them on the national accounting rules.
Exactly.
And then the international rules.
For consolidation,
you have
to change that. So if you are a French subsidiary, you have your book in French GAAP, you present this to the tax authorities, you present this for any other legal purposes that you have, but for consolidation, since you have to use IFRS, those individual statements have to be switched into IFRS, and then you aggregate them together with all other IFRS statements to set up consolidated statements. So there still is double work to do within the European Union. Now, you want me to go on, or I somehow have some other things on my plate here?
Let me see if I get this. Let me see if I have this straight. That the international standards, the International Accounting Standards Board, is a private body.
Yes.
It's not a government agency. They're setting the best standards they can determine, but it's a public interest organization in a way.
Yes.
But yet, individual governments are saying it's in our national interest to adopt this, to have this comparability, so that we can have some transparency across borders by using a common accounting method. But it's in a way, it's public interest groups that are dictating the way to measure things for the worldwide economy.
Well, it's of course the problem that Ross already mentioned, that you give up sovereignty about your accounting standards. And you have to know that for the European Union, the change may even be bigger in terms of institutions than for the US. Because generally in the European Union, all accounting standards are set in a public process, not in a private process. Most countries do not have a private standard set. It's made by the government, it's made by laws and other public regulations. So now you transfer this power to a private organization. You see, even in terms of the approach on accounting standards, that is completely different. So how does the EU address this issue? In fact, when the ISB issues a new accounting standard, it does not become automatically applicable in the European Union. The European Union set up a process where it reviews those standards. And it's interesting to see that, of course, the review criteria, they are, well, you could say they are very technical, but in fact they are only political. And it's the same what you mentioned with the milestones. IFRS have to be of high quality. Well, there you go. But what is high quality, for example? ISB has to be independent. What is independence? You know, all those things are just arguments. So in the European Union, they filter. They have different bodies, public bodies and private bodies, and every new international financial reporting standard has to be officially accepted by the EU Commission. And once it's accepted, it's mandatory for European countries.
Does the International Accounting Standards Board, do they present what they're discussing? Can one see behind the veil of how the decisions are made, or do they just appear?
You mean the European Commission?
European.
Or
No, the ISB.
Well, the ISB has exactly the same procedure for setting up standard as the FASB. So they issue exposure drafts, and you have comment periods, and you can read the comment letters on the internet.
So the meetings are
It's
open, transparent process?
It's webcasted, or you can go there, you can go to London or wherever they meet. So the process is identical to the FASB process because, in fact, it was copied on the FASB.
And meaning that anyone can comment, anyone
Oh, of
can
course.
send. If you think some skullduggery is taking place, you can protest. And so they've got to be open and above board,
Yeah.
else the governments won't accept them as
Yeah.
being in the public interest.
But you have to know, for the European Union, we have this filter mechanism. But in fact, the European Union cannot change one word within the standard. Because there is a general IFRS rule. You can only say that you use IFRS if you use them to 100%. Which means that if the ISB issues a standard and the EU Commission doesn't like it, what choice do they have? Well, none. Because if you do not allow this standard within the EU, European companies will not use anymore the whole package of IFRS, and therefore officially they cannot claim anymore that they use IFRS. Okay, so that means it's a political process, and the EU uses this primarily in the negotiation before a standard comes out. So they will say to the ISB, listen, we are your biggest client, because we are.
Yes.
And the ISB had a huge gain in reputation when the EU adopted this, because before it was not really an interesting organization, let's say. But when the EU got interested, all that changed, and even the US has now some interest. So they use this as a negotiation power, and they say, you know, we don't like this standard, And if you do not change it in a way, maybe we may even consider of going back from IFRS to something else.
So there's political pressure back and forth so that there is government input as well as input from independent experts
Yes.
in getting the standards. So everybody gets a say.
Well, again, the European Union is very diverse, so you have input from individuals, you have input from the different national accounting organization, audit organization, different governments, you have the European Central Bank, and you have European bodies. And everybody, of course, will do his best to move the standards in a way that suits them.
Why don't we switch, first come back to this, but I thought since we've considered already the American experience, which is an isolated stovepipe where all three are combined, to the European Union where it sounds like one government, but it's also 27 more, and they're working out what's the best way to set the accounting rules in that environment, and somewhat political, somewhat not. And I thought it would be useful, since the plot has thickened considerably here, to consider what an individual company, a worldwide company admittedly, but an individual company, what problems that an individual company would face in applying multiple national gaps as well as IFRS within a single organization. And we're lucky, in fact, by design, we have Bill Denning here to explain this from some of the experiences of Royal Dutch Shell or the American subsidiary, or whatever you'd like to say on how this is handled, and some of the hidden problems, some of the benefits that Shell sees in this process.
Okay, thank you very much. I appreciate the opportunity to be here today to share our experiences. Let me first just kind of set the stage as to who we are and maybe our history. Royal Dutch Shell is a multinational company, but we have tremendous operations in the United States. We have been a filer with the SEC for many, many decades. The U.S. markets are very important to us to maintain our filing and registration through the SEC because a third of our shareholders reside in the United States. We have been a U.S. GAAP filer, as I mentioned earlier, for many, many decades. And so when the mandate came out in 2002 to move to IFRS in 2005, that gave us less than a 3-year window to move in that direction. So when we talk about the SEC's roadmap of, as Russ had mentioned, the 2009, 2011, 2014, 2016, that's a wide berth compared to the less than 3 years that the European community had to, in essence, to line up and salute. And so, in IFRS, this is very much a principles-based application versus a rules-based. And so with that, you have some optionality. You have optionality on your initial conversion to IFRS, and then you have some optionality on a going-forward basis also. Because it is very principles-based as opposed to rules-based, I think many people, especially accountants, have a hard time with that because, the literature in IFRS is 2,500 pages. In U.S. GAAP, it's 25,000. So, we like the bright lines as accountants. We like to be able to see, where it tells us we can or we cannot do something. And so in the world of IFRS, it's very, very fluid. Because we had that optionality, or because we were a U.S. GAAP filer beforehand, in our, look at IFRS and how we were going to adopt it and looked at the choices, we tended to veer toward those that aligned with U.S. GAAP. Because we knew, as was mentioned earlier, as we had to file with the Commission, we filed under IFRS, but we had to reconcile back to U.S. GAAP. So we wanted to limit the number of differences as much as possible. And so if you were to pick up a set of our financial statements in the years 2005, 6, and 7, the reconciling differences from a balance sheet and income statement really were very, very small, very, very minute. And we really handle all of this, less than 3 years implementation pretty much, in-house. In 2002, we set up a core team to kind of right-size how we were going to implement this. Had decision papers for every aspect, from cash to retained earnings to sales to net income. Here's IFRS, here's U.S. GAAP, here are the differences. hear your choices. And we made the decision as to which direction we were going to go to. We discussed that with our financial executives and with our auditors to make sure that they are aligned with that. And then we set about, retooling our business. We met with all the different businesses throughout the world. I can't underscore the fact that communication is key. You cannot under-communicate a change of this magnitude to this organization. I mean, at that time we had 10,000 finance professionals in Shell, 100,000 employees. So you need to make sure that you are engaging both internally and externally those that are going to be impacted by the change. And when I mean internally and externally, we needed to make sure that we communicated with our investor relations group so that they could tell that story to the outside world to get ready. We were about to change something down the road. We held workshops, brought in people from around the world to learn more about IFRS and how it was going to change for us. One of the, intangible benefits that we learned and benefited from this change was the fact that we had to go back in and indoctrinate and re-engage with the finance professional, all of U.S. GAAP and all of IFRS, because they, in essence, had to be bilingual now. And if they had forgotten about how to account for plant, property, and equipment, or what's the proper treatment for accounts receivable and bad debt allowance, et cetera, they had to be able to speak both and to learn all of that. So again, this was an intangible benefit that we really picked up in this process, along with some tangible benefits I'll mention in a moment. People have asked us, other companies that are about to embark on this process, what was the cost of this? Did you have to go back in and retool your ERP systems? Did you spend $50 billion trying to make this happen in less than 3 years' time? And we really didn't, put pen to paper to have a number that would say this was the cost, for us to adopt. I mean, most of it was done, kind of concurrently with our day jobs. We did have some outside consultants, primarily auditing firms, that kind of helped us. But during that time, the auditors and the accountants were really kind of walking side by side because we were both kind of learning at the same time. They did not have this vast amount of experience to help us with. They were learning it, and then we were kind of having a dialogue on both sides of the fence. We mentioned the fact that a lot of different countries around the world have IFRS, but each country kind of wants to maintain their own separate GAAP. And Shell does business in 130 countries in the world. And I can probably say that IFRS is prepared for the consolidated accounts, and that's it. The other subsidiaries around the world, including Shell Oil, which is their subsidiary in the United States, prepares their financial statement, audited financial statements under local GAAP. In our case, it's U.S. GAAP, but our primary, entities in Europe, which are the Netherlands and the UK, they're prepared under the local country GAAP for the same reasons you mentioned. It's a tax disadvantage to move to IFRS. And so there's still, I think, a roadmap to be achieved globally if we want one set of global standards. We're not there yet. Even the EU countries have their own set of GAAP basis statements. And that's this tax aspect that we mentioned, for the countries in Europe is going to, I think, be one of the big issues that the United States has to face up to when they, initially moved to IFRS. Some of the other, I think, real economies of scale for this change for us were that we are in a world that we're moving towards standardization of processes, standardizations of ERP systems. We want to pay the bill the same way throughout the world. Our peers are doing that. That's just the way how we can be competitive. This change for us was the opportunity for us to look at our ERP systems, look at our accounting processes and our standardization, our reporting issues, and we took it on ourselves to strengthen our controls in working through all of this. And And all of this harmonization of processes and ERP systems, I mean, the bottom line is
ERP is Enterprise Resource Planning, or is computer system?
computer systems,
okay.
SAP systems.
Yeah, okay.
That's the buzzword for that.
Good.
And of course, those are mega cost systems that you have to maintain. And if you're a company the size of Shell, and if you had 10 or 30 major ERP systems, and they all don't talk to each other, then it's very inefficient. So all of this, was kind of a wake-up call to us to help us to be more efficient in what we're doing. We, as a company, like many of our multinationals, have what we call shared service centers, and that we have parked kind of the standardized processing, such as accounts payable, in one place globally, such as India and Philippines. And so by moving to one global set of accounting standards, I think that translates into efficiencies, into lower cost. I think when you look at it from a SOX control basis, because we have to be SOX compliant, that anything that you're doing on a basis where it's where one size fits all, it's going to cut down on your cost, it's going to improve your internal controls, and it's going to cut down on your auditing costs.
So SOX, the Sarbanes-Oxley Act, which is an American act, but it applies to Shell because you sell your stock here.
Right.
And so American rules on internal control apply to you, and this then causes you to think about the systems, and that gets you to SAP or ERP and getting all these things coordinated. So
Absolutely.
Okay.
Absolutely. We also, because of the fact that we are so diverse, we do business with so many stakeholders. And so if you are all singing off the same song sheet, whether it's joint venture partners, whether it's your suppliers, your vendors, your foreign governments that you're dealing business with, if you know that you're talking the same issue around plant, property, and equipment, as far as capitalization or expense, then I think that, again, that translates in just a better efficiency of how you are running your organization globally. We've talked about comparability and consistency, and that's, I think, what's kind of one of the facets of this particular panel was the fact that we're not all globally consistent and comparable. And I'll give you an example. In the fourth quarter of 2008, Royal Dutch Shell released their earnings, and the fourth quarter earnings were a loss. And the only reason that our earnings were a loss was the fact that under IFRS, you have to value your inventories under FIFO. LIFO is not allowed. Well, our peer companies all use LIFO. So again, Royal Dutch Shell, FIFO, our peers, LIFO. So you have an inconsistency and incomparability there. I mean, if we would have been using LIFO as our peer group did, we would have had, we'd have been profitable. So again, it's the comparability consistency that we need to have in being able to be on one global set of accounting standards.
Could you speak a little bit, just while we're on this subject? You've spoken of external reporting, and I think you said that the IFRS is for the combined group,
right,
but each individual country was on national GAAP
right.
basis. And I'm wondering, when you run Shell within the company, what method do you prefer as a Shell manager, or do you want them all on national GAAP, or do you want them on IFRS, or does it matter?
I mean, our books and records, if you ask people within Royal Dutch Shell, are kept on IFRS. And so to the extent that you're in Brazil, United States, China, Russia, Zimbabwe, and you're under that local country GAAP, that's that local country's problem, not corporate headquarters.
Yes.
So again, you're still having to keep two sets of books, and you've got some tension there.
So national rules for statutory purposes within country, but Shell communicates with IFRS worldwide.
Yes.
Were you at a stopping point? Are you through?
I'll stop right there.
Okay. Well, I didn't mean to cut you off.
No,
but I thought it was a good break to kind of tie this back together. And other thing you said was that IFRS was principles based, and I thought I'd like to get the reaction of the other two on what principles mean. I thought it might mean more judgment is involved, so that local managers have more discretion in how they account for things locally. And I wondered if that's on the right track, or is comparing American GAAP and I guess some national gaps in Europe, is that true? There's more judgment allowed, more discretion allowed by management, and what is your thinking on that as professors?
Yeah, I was hoping that comment would come up actually, because this is a very important distinction between U.S. financial reporting and international financial reporting, or at least it's alleged to be an important distinction. So some people will say it's not, it's mostly talk, the differences. Others will say it's meaningful. What the allegation is that U.S. GAAP is very rules-based. As Phil said, has 25,000 pages, which is a lot of rules.
That's a lot.
Whereas IFRS is more principles-based. A probably oversimplified analogy that I use is with traffic laws. So a rules-based law would be speed limit of 45 miles an hour. A principles-based rule or principle-based standard would just set the objective. The objective is drive safely given the current road conditions, and then allow you to decide what is the appropriate speed to go. And of course, in the back seat, you have an auditor who's looking over your shoulder to determine whether you're driving appropriately for the road conditions. Now, in the United States, that auditor is looking only at the speedometer, because it only matters whether you're going 45 or not. It doesn't matter whether it's night or raining or icy or anything else. Whereas the idea is, in a principles-based world, the auditor is taking more into consideration. Now, going back to our financial scandals in the early 2000s with Enron and so forth, there was a lot of blame assigned to accounting rules or bright line tests in U.S. rules. And that gave rise to a strong impetus away from rules and toward principles. And I think that led to a lot of the momentum behind moving toward international standards, because they allegedly are a lot more principles-based. And so in addition to becoming more harmonized with the rest of the world, we would also get that benefit of being on a more principles-based set of accounting standards. Let me just make one other comment, and I'd be interested to hear what the others have to say about this. And that comment is that moving from a rules-based set of standards to a principles-based is not only that, but requires a completely different perspective from the preparers and the auditors. You can imagine if the traffic rules were drive safely under current road conditions, you might feel more personal responsibility for driving in a safe manner. Or you might feel more license to drive fast. And the allegation is, under traffic rules as they are in the United States, that people are only asking themselves the question, am I going to get caught? And so I think that's analogous with accounting, that the worry is that under U.S. rules, the way they're currently written, the mentality among preparers is, am I going to get caught? Rather than thinking more broadly about, am I reporting the right values under the current road conditions and driving conditions?
So from the European point of view, of course I'm aware of this discussion between rules-based and principles-based, and of course from an American point of view, IFRS are very much principles-based compared to rules. But if you check in the European Union and in Germany, for example, you will see that IFRS is much more rules than German GAAP. So the fact, if you say it's principles-based or rules-based, in fact, depends from your point of view. I mean, there's no absolute measure to say when it's a principle, when it's a rule. So you mentioned correctly 2,500, now it's maybe 3,000 pages of IFRS. Well, if I take German GAAP, that's maybe 50 pages. Okay, so if you move from 50 to 3,000 pages, where you have, for example, 400 pages just to tell you how to measure, not even disclose, financial instruments, I don't know if that's principles-based. But just my point is, it depends on where you're coming from. And you said also, and I understand this from an American perspective, that auditors and accountants are not very at ease using those principles because you want to have your guidelines, especially in the litigation environment in the US. But in the European Union, we have much more use and experience of using those principles and to do judgment. And it's exactly as you say, you need more judgment, and it's a learning process. And I personally, I don't have the answer how this works in the US litigation environment, and we have to find out, I suppose, if IFRSs are adopted. Now, generally speaking, what is supposedly better, to have more detailed rules or more principles? Of course, given my background, I'm more a principles guy, because I think in a rule-based approach, you are running a race that you will always lose against the companies. Because what companies do is, and we have exactly the same thing in tax regulation, for example, which is very detailed too. Well, as soon as a new rule comes out, which is very detailed, well, companies, if they don't like it, will seek ways, legal ways, of course, to circumvent those rules. And that means, well, 1 year or 2 years after the rule is in effect, you have to set up another rule to capture this new transactions. And that's exactly the same thing you do in tax laws. And we see where this is getting us. You know, after several years, you have so many pages that nobody understands the whole thing anymore. And you need experts for this paragraph and this paragraph and this paragraph. And I think in a principles-based world, this danger is smaller, because the rule is not 45 miles, it's given the circumstances, so it's easier to, or it's more difficult to try to set up something to circumvent the rule, because there is always maybe an auditor who tells you that, well, even if you set up this transaction totally different, the economic underlying structure is identical to what you did before, and therefore you have to do exactly the same accounting treatment. Therefore, of course, I'm more in favor of principles-based standards.
But we also have a corporate manual, so to speak, of accounting policies that's, you know, it's, again, IFRS focused. And you kind of have to work within that framework, and the managers around the globe. And, you know, these are the rules, and if you feel like that you need to deviate from them, then you need to ask permission from the group controller as to, you know, does this apply to you or not? So, again, we as a company, because we came with a lot of history with U.S. GAAP, we, again, sort of veered toward U.S. GAAP. So we probably have more rules in our corporate manuals than other companies.
So it's easier within a company because you have the shell culture worldwide,
right.
And that gives some guidance on how to make the judgments. But in an unconstrained IFRS application, managers are left to their own discretion. It's my judgment versus your judgment. And think about this auditor, this person who comes in from the audit firm who's supposed to verify that IFRS has been followed close enough. And you have, under IFRS, as I'm understanding it, you have more judgment allowed in the process. And the auditor comes in and must make judgments about judgment. So in American rules, it might be this much discretion. But with the IFRS, this much discretion, and the auditor now has to audit those judgments, and there's some uncertainty about what's right, so it gets even wider. And it means there's more discretion on the part of management. And so as Ross said, it comes back in a way to the trust or the trustworthiness of the managements in doing this. And I'm wondering,
Let me ask,
yes,
one more point related to what you're saying, which is that there's a big question of whether the major auditing firms in the United States, if we went to a principles-based system, would have the tolerance to allow client A to reach one conclusion and client B to reach another conclusion in the same economic circumstances, even though they're both okay within international accounting standards, or whether they will create their own internal rules, just the way Royal Dutch Shell has, to constrain people's behavior so that it's more consistent across the auditor's practice. So I think that's a very open question, whether the rules might actually no longer be made by the Financial Accounting Standards Board, but by the major auditing firms.
would that be acceptable to have, there are what, 5 or 6, maybe 7 global network firms that do business all around the world that have, if you will, an internal manual, as Royal Dutch Shell has, of how they do audits. and they've got substantial capital as a brand name in enforcing these rules, would that be bad to have them have some standardized rules?
Well, I don't, it's hard to say whether it would be good or bad, but it would be pushing the standard setting in the United States down into no longer at transparent level, no longer by private, not-for-profit entities, but be made by profit-making entities in an invisible way.
And that brings up the point of transparency, public interest, due process, sunshine for setting standards. And I should say at this point that the International Auditing and Assurance Standards Board, parallel in many ways to the International Accounting Standards Board, is another public interest organization that has input from practicing auditors, from bankers, from governments, from individuals all around, operating in sunshine, that tries to set transparent global auditing standards that parallel the same thing for accounting standards. That's another vehicle to get worldwide, to get input worldwide to set high-quality auditing standards, so you do get this reasonable process. And it does overcome that one limitation of the firms doing it. Let me ask this question. I know that Europe differs from America in many ways. One way that they differ is they've adopted IFRS. The U.S. hasn't as yet, although Canada has, and we may soon. But another difference is that executive pay, executive compensation, is an order of magnitude higher in many ways in America. CEOs making 300 times the average worker, and in Europe it's, I don't know, 10, 100 times.
Smaller. Right?
Much smaller. And if it's true that the only measure of performance worldwide, the only measure of responsibility or accountability worldwide for companies is the standardized accounting process. So accounting, forget about accounting for within country purposes, but think about it as a way of measuring and having accountability worldwide, then the accounting is very important in judging how people are doing. And Ross talks about the car example, and as I'm understanding what we're saying here, IFRS allows more discretion on the part of managements. And IFRS might work well in Europe. I'm going to say for a moment purpose that it does. Does that mean that IFRS would still work well in America, where the executives, the CEOs, the CFOs, who are making 300 times the workers' pay, where it's much less in Europe, where the accounting process is, in a sense, more important because the executive pay depends upon the accounting reports, and if they get more discretion, that might be bad in America, even though it's good in Europe, if management has too much discretion. And furthermore, if the auditor can't audit these judgments well, I mean, either you got to have good auditing standards, or maybe you need to have more rules. But it's an open question. Go ahead.
Well, as far as the auditor, of course, has an important role to play here. And if you assume that the only motivation for managers to present financial statements is to cook the books a little bit in order to increase the profit in their compensation, maybe that's a little bit overstated, but auditors, have an important role, and in the European Union, they try to deal this within their network, because the big audit firms are organized as legal local entities, but of course they have one brand name, Deloitte, Price, and the others. So in the European Union, you have working groups within Price Waterhouse, for example, in Europe, in order to have consistent application and in the same circumstances to get to the same solution A accounting, and not A in one country and B in another country, so that they are consistent across borders, and that not Ernst & Young in the UK gives another solution than Ernst & Young in France, for example. So they have those working groups within the network, but also the audit companies between them. They meet and they discuss points, so that companies cannot so easily do auditor shopping. Like, it's better to take this audit company because they're much easier going compared to the others. They're very strict and they try to organize themselves. But of course, again, that's in a principles-based world, there is more discretion. So That means if you assume that the managers behave only opportunistically and try to increase their compensation, well, the only barrier to this is the auditor. And he has probably experience from other companies where you can say that in those circumstances the judgments that you did is overstated, for example, and maybe you should be more conservative or prudent.
And I think you said that the audit firms are organized within each country.
Of course, there are legal entities, local legal entities.
Because the accountancy laws require that, country by country. There's no global firm.
Yeah, well,
but yet Royal Dutch
way
Shell
how
is a global firm. This is...
Well, they have different legal entities in every country. That's why they have a French subsidiary and a UK subsidiary and a US subsidiary.
So this is a complicated problem. This is a complicated design problem to get all these things to work together, and yet to have the potential of a worldwide market and worldwide accountability, we've got to find a way to get the accounting, the auditing, and some kind of enforcement.
You need more, in this case, other or additional mechanism to avoid that managers, for example, try to overstate the financials for compensation purposes. Audit committees and compensation committees.
Audit committees being
within the company.
Within this is in the governance, those charged with governance, so to speak. So it's the corporate governance, which is not the strongest mechanism imaginable, but it's the only way to control a global corporation. And a lot of factors here to be blended together, and I think this blends well with our charge for this conference topics today, or today and tomorrow, that there are complex problems that require a lot of different mechanisms, a lot of different persons involved, different expertise, to somehow get across borders to get solutions that will work well enough for us to capture the benefits of globalization.
And I think it's important to understand what Phil already mentioned. The change to IFRS is not just accounting standards, because as you certainly experience, almost everybody is concerned. I mean, you have human resource people who have to think about what type of compensation to give because there's an accounting impact. You have salespeople, they have to think about the sales contracts because under IFRS they might be accounted differently than under US GAAP, so probably you have to review all your contracts that you had and set up different types of standard contracts. So at least in the European Union, and Shell is part of this, all services are concerned. It's not just some accountants that just change one rule from the other. It has impacts on your contracts, compensation, and a lot of other things.
Very good.
I think.
But both the boards have been working concurrently for years. On the standards that are so complex, trying to converge, and so I really see that once we get closer to the end of this tunnel, most of the major accounting standards between FASB and international there's going to be some differences. They're not going to be aligned 100%, but conceptually, they're aligned and marching in the same direction. Both set of standards have what they call a concept foundation behind them that are, and again, both boards are working toward to make sure that the concept statements, which underpin the accounting statements, are aligned, or are pretty much aligned. So it's not like you've got a transaction that's going to be red in one country and black in another. I think it's going to be those that are somewhat fuzzy. I mean, we live in a very complex business environment, and so I don't think that you could ever write a set of U.S. GAAP that's going to address everything that's going on out there in the world today. There is some judgment even under U.S. GAAP. But there is a body now that's in the IFRS world, IFRIC, which is an interpretation group, and kind of like the EIT, Emerging Issues Task Force, within the American group, because there's this need for some more granularity, even though it is principles-based. Still, the constituency wants to know. I need to know more. So as you mentioned, the pages are growing in the international library.
Well, I think you can see from this discussion so far, there's a lot going on here requiring new solutions, innovative solutions, and we have some time left on the clock here for questions from the audience, if anyone has them, or if anyone on the panel would like to ask questions of the other panel members, we could do that as well. But I'd like to open it up at this point for other input. Yes.
Yes, if I may, I might address this question to Professor Hospital to start with, and others, of course, wish to jump in or welcome. But given an environment where there are listed companies, publicly traded companies, some 9,000 you mentioned, under a common set of guidance, is there an issue across some 27 countries that given this common body of guidance, that the actual implementation is systematically different and the interpretation is systematically different given the historical backgrounds of these multiple jurisdictions? And is that something that, if it is the case, remedies itself over time, or we just live with that, or is it perhaps not the case?
Well, you are absolutely right, and this is the general problem of comparability, and related to this, enforcement. Because, as I mentioned already earlier, there is no European Union enforcement body. The international standard setter itself, it's just a private organization, cannot enforce anything on anyone. And that means, indeed, IFRS is used within the European Union by all those companies, but every company in every country, of course, tried and tries to maintain a maximum from its national GAAP. Because remember, I still have those national GAAP statements. I have to transfer them to IFRS, so I try to use accounting treatments that are similar or identical in both GAPs. And there you go again, you will have a German treatment, and you may have a French treatment, and you may have an Italian treatment, because all those GAPs are different. And this is a big issue within the European Union, and there are different initiatives trying to avoid this, or trying to smooth things out over time. And one is, for example, that the European Securities and Exchange Commissions, every national ones, they meet and they talk about problems, accounting problems that they were facing, and what decision they should take under IFRS. And those discussions and decisions they take, they are published in a database that companies and, of course, other regulators can access. So if one regulator does not really know how to treat this problem, he can check in the database and therefore impose, if possible, coherent treatment with what the other regulators are doing. But there is no European enforcement mechanism, and therefore, for now, we have to live, I think, with different IFRSs. And maybe another point I might add is that you should never forget that accounting standards, they just not drop from heaven one day, but they are the result of decades and centuries of other things going on, like the economic environment, how you finance companies, if you are in an inflation environment or not, the legal environment, if you are more a code law country or like the US, a case law country, the education, is your education, accounting education, very good or not? If you are an agricultural society, probably you don't care about financial instruments, you have other problems. That means all those national gaps, of course, they are the result of all those surrounding factors. Now, if you switch to IFRS, you switch just the accounting factors, but all the environment, of course, has not changed. The legal environment is still the same, and companies still do the same type of financing, which creates some type of incoherence between what what you report in your financial statements and all the other environment, and those two, they do not necessarily match again, which of course is a problem. And we talked already about the tax link, we have other legal issues, and that's where you see those frictions, and you may see them in other countries that apply IFRS in the future, especially if they're not in the developed world, because you may have accountants, you may have auditors, you may have readers of financial statements. They do not understand those financial statements because they are much too complex and they're not adapted to their environment. And that's another issue for comparability and enforcement. So just switching everybody to IFRS does not necessarily lead to comparable financial statements.
I just want to add a little bit to what Chris said and take it to a global level. So while we have global companies, we have global audit firms, we are moving toward global accounting standard setters, global auditing standard setters, we don't have global regulators. Regulation is done within each country. So as Chris said, there's an organization at the EU level that tries to coordinate EU regulators. There's an international organization that tries to coordinate global regulators called IOSCO. And it's an organization of securities commissions, of which the SEC is a member. And so while the SEC doesn't set rules in the United States, they influence rules in the United States in a number of ways. If they cede sovereignty to the International Accounting Standards Board, they will lose some of that flexibility or that ability to influence the rules, and they will have to then begin to work more through the international organization, which is just a loose arrangement on a consulting basis, rather than having being a binding law as it is in the United States.
That raises, I think, a fundamental question, and one that might be an appropriate way to end. And that is, as we've heard, the three legs to the stool: accounting methods, auditing standards, and enforcement. The first two we might get combined. The third one, we're not going to have a worldwide government. How to get around that problem is certainly a design question. But the overriding question here to me, for America, is if we agree for once on IFRS as the way to go, and it's set by experts that are independent, when Congress wants to intervene and override those rules, then we're back in the same position. It's really a question that I think all governments have to answer. Would it be possible to set the standard setting for, say, accounting and auditing with independent experts who were expert themselves, who were not tools of management or tools of the auditor, but set on an independent basis, and once they do that, agree to abide by those rules and hands off. Now you say the governments can choose to follow along or not, but that may be the way to go, that to rely upon public interest organizations with input from anybody who wants to provide input and with due process, so to be trustworthy. That may be the only way we can get the standardized rules, and then perhaps allow individual governments to enforce these rules on a local basis. Might work, but then again, that's one of the unanswered questions about standardized accounting globally. And in the spirit of the entire conference, many unanswered questions, and what we're trying to do is expose these problems so that younger and brighter minds with different backgrounds can see what they can do in solving these challenges. Well, thank you, everyone. We're at the end of the time period right now. We've been stimulated, we think, by our own talk, and we hope you get some ideas also. And thanks for the opportunity.